and LinkedIn and some other places. I don't know. But hey, I'm Jordan Berry, Laundromat Resource. Excited to chat with you today about something that we don't really ever talk about here. We got cost segregation conversation happening. We've got Chris Pierce on with us. What's going on, Chris? How you doing, man?
Great, man. I'm good. Glad to see you again.
Yeah, likewise. Chris was on the podcast. I don't know, maybe like 2 weeks ago, week and
A
a
couple
half, two
weeks
weeks
ago.
ago. And dude, really good time. We're here because we want to talk about how to save you money on taxes, how to properly position your portfolio, and what to do with it as you're going through that process. So if you've got questions about your particular situation or just in general about how to utilize some of these tax strategies, that's what we're here for. Just throw them in the chat. And actually, if you're out there right now, if you could just throw, hey, what's up in the chat there, just so we know that you're out there. I see there's some people creeping on here, but now I got to find the chat on my end. Oh, here we go. Found it. You act like, I act like I've never done this before, but I don't know. I've done like tons of these. So I don't know. Yeah. So, anyways, say what's up in the chat. If you got questions, get them in there. But Chris, tell us a little bit of background on you. Who are you? And you know what are we talking about today? What is this cost segregation we're talking about?
Yeah, man. So Chris Pierce. I live in Colorado, um, in the mountains, not the rest of Colorado, which is just like Denver area. I actually live up in the mountains, and I first came across cost segregation several years ago when I had bought my own business. I was running it out of my house at the time. It was not a laundromat. That'd be weird having like a bunch of machines in your basement and people like coming to your house. It was not that. And as we were expanding and kind of and working through some different things, I had looked at getting my own building, and that's when I first came across cost segregation. And now I help my friend's company, Maven Cost Segregation, which is who I am with and who I represent. And I've become an expert in the field that I had started to dig into initially as a client. And now I help other people understand and navigate the complexities of it to save on your taxes. So, to your other question, what is it? It is a way through your real estate that you own or your real estate investments to reduce your tax bill in like the shortest soundbite way possible.
Yeah. Sorry, just interacting with the chat over here
Yes, this
a little
is
bit.
live.
Yeah, we're live, Stuart.
Yes, Stuart.
Stuart's great. Stuart's great. Uh, I should have been wearing. He sent me over a bunch of Tumble Club stuff. That's
Oh,
his
cool.
chain out there in Australia that he runs. So I should have been sporting it today. If I would have known, Stuart, you were going to be here, I would have been sporting it. Uh, who is this for? Cost segregation. Who is this for? Who needs to be paying attention to this, and who can ignore it?
Yeah, this is for, uh, I mean, as far as to the best of my knowledge, I specialize in the US part of tax segregation. So if you have a building or a business and you're outside of the US, I cannot be 100% if there's tax law in your country that would cover this. So I'll start with that. The
Mm-hmm.
second part would be if you're buying a business, a laundromat in the United States, and you are actually acquiring the property, the land, the building. If if you're doing either of those two things, then this is where this conversation is really relevant for you.
Yeah, and I should point out too, even if you're not buying a laundromat and you're just buying a commercial building, right? Uh, or even a residential retail rental building as well, right? Or correct me
Yeah,
if I'm wrong.
yeah. It could be any investment property. That could be
Yeah.
residential. It could be like a long-term rental. Be a multifamily property. I loved Cody Sanchez's take on like do the profit loss review periodically. I don't know if anybody's familiar with that, but she would look at her profit and loss and she'd try to find something in her loss column and see if she could do some sort of acquisition that would turn it into a profit column. So if she was paying rent for her, well, stay with the laundromat in like a strip mall, she'd see if she could buy the whole strip mall and then turn the whole strip mall into profit source and a revenue generator as opposed to just something to continually spend money on without having any kind of equity into. And so if you do something like that, you own the whole strip mall, you own a piece of property, you have a short-term rental even, or you somehow built a multi-million-dollar apartment complex, like this is for you.
Yeah, it's a big deal. Okay, so how can just on like a overview terms, how does it actually help you? So let's say I buy a laundromat with the commercial property. How does the cost segregation actually help you? What does it actually do for you?
Yes. So the first thing to understand is always going to be the depreciation part of it, right? When you buy an investment property in the United States, the IRS allows you to depreciate that property, which is a non-cash expense that the IRS allows you to deduct from your taxes. So it lowers your taxable income. And they do this so that you can continue to invest in the property and like make it better. Like it's kind of cool that the IRS doesn't want our buildings in the country to just deteriorate and fall apart and fall into ruin. So they allow this to take place. So also in the Internal Revenue Code, they've acknowledged that various parts of buildings depreciate faster than a normal investment property. So if you bought a normal investment property, it might depreciate over 27 to 39 years, depending if it's commercial or residential. But the Internal Revenue Code also states, well, certain types of flooring, if you put those into a property when placed in service, it's a 5-year depreciation schedule. So all we do in the process of a cost segregation is our engineers come through and look at all the components that are already in that building and recategorize them into shorter life cycle depreciation schedules that the IRS already says you can claim them on. At that point, you can accelerate the depreciation you can take. So rather than taking 39 years to have all those deductions just slowly chip away year over year, you can push forward a lot of that depreciation so that you have bigger deductions in the initial early years.
Okay. Makes a lot of sense and super powerful. I mean, I think you can start to see how powerful this could be. I mean, if you're depreciating over 39 years, I mean, that's a whole lot of little chunks, right? But if you're able to break that up into some of those chunks are 5 years, 7 years, 10 years, 20 years, whatever, uh, those chunks start to get a little bit larger depreciation there. And so it benefits you cash flow wise. Well, maybe we should just back up. There might be some people who watch this that don't even know what depreciation is. Maybe you can explain what is depreciation and why is that beneficial?
Yeah,
I recognize probably most people listening to this. This is like, dude, don't waste our time. But I know there's some people out there that this is going to be a new concept for. So let's briefly talk about what is depreciation.
of course. So and I'll try to keep it in the context of like a laundromat too. So if you are building out a new laundromat, you get a new space and you're going to be buying new machines. When you invest in those new machines, it's equipment. There is uh, code in the Internal Revenue Code. The IRS lets you deduct the expenses associated with that. A lot of times, something like heavier machinery, there's a few different ways you can actually like claim the deductions, but the most common way is to put it into a depreciation schedule, and it depreciates over a certain amount of time based on whatever that asset is. So if you bought like a work truck, to do like pick up and drop off for laundry delivery, and you put a wrap on it, well, you can like deduct the wrap, you can deduct the truck. The truck is going to go into a depreciation schedule. So over the next, I think it's a 7-year depreciation schedule on a work truck. You're going to have a certain amount that you can claim as a deduction on your taxes every year for that business. So those deductions, when you have something in a depreciation schedule, the deductions are pre-tax deductions. So this is lowering your taxable income. And then when you finally get to whatever that adjusted gross income is, that is then where you're taxed. So it can have a lot of substantial tax savings. So in the context of investment properties and cost segregation, if you had an adjustable base, a depreciable basis on a building that you bought of $390,000, then over the next 39 years, it's going to be straight lining depreciating, meaning you're only going to be able to have about $10,000 every single year that you can claim as a deduction for owning that building. Well, some of that building is going to depreciate faster, right? Flooring might have to be replaced sooner than 39 years down the road. So that's where the cost segregation happens. And so all we're doing is like normal cost segregation. There's two standard ways that the IRS does it. One is called like MACRS or MACRS, which is, it doesn't make a whole lot of sense to me like how it's calculated, but it runs through a calculation. It's kind of, some of it is front loaded, but it's not like the same value every single year that you would take. Straight line depreciation is the same value every single year that you see. And that's what you see in real life depreciation schedules of a property, which would be 27 and a half or 39 years long.
Yeah. Yeah. And you may have heard the term like paper loss or something on a building, or a business or something. That's basically like, hey, on paper this business loses money, but in reality it makes money, and that can be a little bit confusing to people. But part of it is this depreciation, the ability to depreciate property, equipment, stuff like that, where you can actually, go in and it's almost like an expense line item for you, but it's a paper expense line item. It's not an actual expense.
Exactly. You touched on it right there. Like in the definition of depreciation is a non-cash expense. So it's like, it's an expense like that you have that you can deduct from your expenses, but it's not coming out of your actual cash that you take in, which is kind of wild.
So, question here: what income can you depreciate against? Is it like, can I depreciate against my laundromat income, my job? Like what can I depreciate against? What revenue or income?
Yeah, this will be for the most part in a laundromat. You buy the building, your business is operating out of it. The part of the building that your business is operating out of can offset your active income from that business, right? So really, there's two kind of pillars for taxation in the U.S. You have your active and your passive. And so anything that you're materially participating in, to use the IRS definition, or like actively involved with, is your active income. So like if you have a W-2, that's your active income, that's your active work. You get taxed in that active pillar. If you have investments that would be considered passive, you're not actively engaged, you're not materially participating. For the most part, real estate investment, like if you just bought single family homes and you lease them, for a year, 2-year leases, that'd be considered a passive investment. So any losses or gains from that type of investment would affect your passive investment pillar. So it can happen either way. And what we're always going to try to do is to look at a way we can reduce your active taxes as best as possible.
Yeah. Yeah. And one of those ways, I mean, you kind of touched on it there a little bit, of if you or a spouse's primary job is being a real estate professional, and that can look like a few different things, then it opens up kind of a whole new world to you a little bit in terms of offsetting active income as well. Is that correct? Am I understanding that correctly?
Exactly.
Yeah. So that's definitely something to be worth looking into, especially if you're maybe somebody who has a high income or has businesses that, earn a lot of active income that are not in the properties, and you have a spouse who's, not pulling their weight over there. They're just not cutting it. You got to make them a real estate professional, and for tax reasons. So I'm just kidding. No, but it can be like I hate the kind of tax loophole, catchphrase or whatever, but it can be a little bit of a hack there.
Yeah, I mean, if you Google like short-term rental loophole, that's the strategy you come up with, and it's named that way because of just the way the code is written and things like that. So, and it is a very, very effective. We do that with a lot of our clients.
Yeah. Okay, so on the actual process of doing this cost segregation, can you walk us through? I think it's just questions about like what does this actual process look like, and how do I know? Well, let's start there. What's this process look like?
Yeah. So first, we always gather some initial information about a property so we can get you an estimate. If you decide to move forward and we actually do a study, then we confirm some of that information. So like whatever your purchase price was of the property or the business too, if you do it, if you acquire the property through the business, then that'll be broken out in various categories, right? Like the real property, the FF&E, your goodwill, any of that nature. And so we'll take whatever that real property value is, and that's your starting point for us determining your depreciable basis. So in the Internal Revenue Code, land is not depreciable. Like land is going to remain right. And if you think about why it's not depreciable, it starts to make sense, but you kind of have to get a little meta with it. Like land doesn't really break down in a way that needs improvement where like real property does. So
Yeah.
we figure out that land value, we subtract that, and that's where we would start. So we gather some information, we make sure any kind of improvements you did on the property are included. Then we have a site visit. So with a site visit, it could be in person, we can do them virtually too. Where if it was like a virtual visit, you join from your mobile phone and talk with our representative and walk the property. We record it, and then our engineers go through those videos and the recordings of everything, and look at every component we can find and recategorize that into the different cycles and the different buckets. So at the end, you get a report where every component in your entire property, it'll be like the flooring, the paint, the walls, the drywall, the studs, the extra machines, the lights, all of that are in various categories so that we can get the most out of the depreciation that we can.
Yeah.
And then you take that to your CPA and it's applied to your taxes.
Like magic.
Just like magic.
It's like magic. Yeah.
As long as you have the right CPA.
I was gonna say, I'll tell you the best thing that ever happened to me was finding the right CPA, finding the right guy. Because I tried doing my own stuff for a little while there, and then things started getting a little complicated on me. And it took me a couple people to find the right guy. And I think I've said this before. Maybe we talked about this on the podcast episode, but like I had a guy helping me with taxes that was afraid of audits. Like he didn't want to take like legitimate tax deductions because he was afraid of audits. And I'm like, dude, I don't want to work with somebody who's afraid of getting audited. Like, and so I have to pay more money because he's afraid to get audited, right? So you gotta have the right guy. Get the right guy.
Yeah. Yes,
or gal.
100%.
I mean, it doesn't have to be a man. It could be a woman too. But get the right person in your corner. And I mean, I think obviously like that's just true just across the board in general.
Yeah,
right?
yeah. You can extrapolate
people.
that to like any category.
Yeah, you're working with good people, good things happen. And you work with bad people and bad things happen. For sure. Okay, so how do I know, like, let's say I bought a commercial property, and by the way, welcome everybody out there who's been joining us, pinging in and out. If you got questions, throw them in the chat. That's what we're here for, to get those questions answered. So make sure you get them in there. But how do I know if I buy a property, how do I know if it's going to be worth it or not to do a cost segregation study?
Easiest answer is we do free estimates. That's probably the easiest way to look at it. We actually look at the photos that are submitted initially with like when we do the estimate to take into account those different things. Like if you had tile flooring in your property, that technically falls under real life category. So that would be depreciated over 39 years. Whereas if you had laminate flooring or carpet, if you have carpet in your laundromat, you might have some challenges with that.
Bigger problems.
Bigger problems.
Taxes.
But
like mold.
that depreciates faster than the tile does. So like we actually do take that into account. We're looking at those little components in there to see, can we get 15% out of this? Can it be 30%? Can we get 40%? Like how much can we accelerate? That's ultimately going to be the best benefit for you. And we didn't really talk about this yet, but I mentioned just changing the depreciation schedules and accelerating, but the current tax law allows you to take bonus. So what that means is anything that can be accelerated into shorter life cycles can be claimed at 100% bonus, meaning you have a $390,000 building. If we can accelerate 25% of that, well, roughly $100,000 is what we're moving forward. that means you have roughly $100,000 deduction on your taxes that would affect either your active or that passive pillar that I talked about before. So
Yeah. Yeah. And I'll just mention this because this is going to live on forever and ever and ever. And people are going to watch this for ages to come. But I'll just mention that, hey, like, listen, the laws change, the code changes, all that stuff. So what we're talking about right now is relevant to today. So make sure you connect with these guys to see if it's still relevant to you whenever you're watching or listening to this. But that bonus depreciation, you can see. Oh, go ahead.
I was gonna say current tax law and under the previous tax law. So even if you bought a laundromat and you had the building, but like in 2020 or 2019, you could still get 100% bonus there. We do a change in accounting method, and we can still we have to prorate like stuff you've taken versus what the cost seg would have accelerated, but it can still be massively beneficial. So even in the last since like 2017 when the 100% bonus first came into effect, there is still bonus available. It doesn't have to happen like right when you buy the property. Some of it changes, but yeah, to your point, like if you're watching this 10 years down the future, because this content is that evergreen,
Yeah.
then the tax law might be very different. You just might have to consult somebody different at that time.
Yeah. And, I mean, that brings up a really good point. Like, if somebody's bought a commercial property, with their laundromat or just in general, this could be, or a residential rental property. I mean, is that something worth coming to you guys and saying, hey, is this something that maybe is going to be beneficial to me?
Yeah, absolutely.
So you
Absolutely.
think you said like 2017 on basically?
Yeah, so late September 2017 is the first time the tax law changed to allow new to the taxpayer buildings to take any bonus depreciation, and then it was also the first time 100% bonus depreciation was implemented.
Out of curiosity, this is just for me now. I'm
Yeah,
kind of just nerding out a
that's
little
fine.
bit, but I know until Trump came back and reinstated the 100%, we had been sort of decreasing
Mhm.
that 100% down to 80, then 60, etc. So if I bought a building when it was like 60% bonus depreciation, is that what I'm looking at? If I were to do it now for a building that I bought like 2 years ago or whenever it was 60%, does that make
Yeah,
sense?
it does. So I'll say this as best I can. So there's about three rule sets right now of like where things have bonus depreciation in them, right? There's like pre Tax Cuts and Jobs Act, so pre September 2017, during the Tax Cuts and Jobs Act era, and then one big beautiful bill. And so within Tax Cuts and Jobs Act era, there's some of it was being grandfathered out on like each year. So like starting in 23, that was the first year it went down to 80%, and then it would drop 20% every year if you placed it in service in that year. So if you acquire it during that area, your acquisition date determines one of those three rule sets, and then the in-service date of the asset determines the amount of bonus within that rule set. And it really only applies to like the Tax Cuts and Jobs Act era, but um, you know, whatever happens with one big beautiful bill in the future, and who knows if that gets phased down the road. For the most part, that should still be the same. Again, tax law can change all kinds of different things, but currently that's how it is. So all that means is like if you bought a building in like 2023, we'll go 2024. That was 60% bonus year. So you bought a building, a laundromat in 2024, and it's placed in service right away. You are eligible for 60% bonus depreciation on that building. If you didn't do a cost segregation then, but now you're looking at doing it for your 2026 or potentially even your 2025 taxes, you can still do that. It just applies the 60% bonus depreciation.
Yeah. Okay. Okay. Cool. No, that's super helpful. And I mean, the reason I'm kind of asking these questions too is because I know there's gonna be people who watch this who, have purchased buildings during these different times, and it can get a little confusing.
Yeah.
Because the laws keep changing and we're bouncing back and forth. 100%. Okay. 80, 60. Okay. Back to
Yeah, I've had
100.
some arguments with some CPAs about the exact same thing. They're like, no, they get
Yeah.
100% because that's the law. It's like, yeah, but the intent, they already had the property before. Like they can't. Yeah, it does change. It is something unique. So
Yeah. I should just ask you this right now before we go any further. Listen, people are watching this and are intrigued or want to get that free call to see, hey, is this going to make sense for me? Where do they go?
yeah, easiest ways to email me, Chris, CHRIS .P at mavencostseg.com.
Chris.p at
able to help you out.
mavencostseg.com.
Yeah.
Yeah. Awesome. So make sure you reach out to Chris if this is something that's intriguing to you. Okay. So, talking about purchasing these buildings. I mean, first of all, do you guys specialize in like retail buildings, or do you guys do all?
If I had to say, we have a specialty, we specialize in detailed engineering studies, which it's on all kinds of buildings. I've helped a lot of people with short-term rental loophole, which we mentioned a little bit before. I've also helped a lot of clients with some larger retail buildings, some warehouses. We've done some large multifamily stuff. I think we did like a 200 unit multifamily not too long ago, which is a big project. And then we've done some like strip malls and other smaller commercial buildings as well. Yeah, it really is across the board. So I mentioned like we specialize in the detailed engineering studies. So the IRS actually outlines like 6 different ways you can do a cost segregation. And the top 2 would be if you bought some land and you're building an entire property from the ground up, you keep track of all those receipts, the whole project cost. That would be the most detailed way you can do a cost segregation, which would be the detailed engineering study with receipts of like every transaction. The second most detailed way is if you don't have those receipts, like you bought the building used, which is probably how most people come into real estate.
Yeah, normal.
Very normal. Then we do the detailed engineering studies with, if there's improvements that you have, then we can use those receipts to supplement that. But we go through and we use the images and the depreciable basis that you started with to come up with how much we can accelerate.
Yeah.
So
okay.
We specialize in the 2 most detailed ways that you can do. And ultimately, when you get super detailed with that means that you can accelerate more. You can get more benefit from it, right? Like I think we talked about before with you kind of did like a DIY cost segregation. Nothing against that. That can be perfectly acceptable for a lot of people for what their needs are. If you're looking to get a lot of benefit out of the property, then you can get more detailed with it and you get a lot more.
Yeah. I mean, that's for sure what I would recommend. I don't recommend DIY.
I don't want to drive a bus over you deliberately, but
you can just back it on up. Right. I'll be the speed bump. No, I mean, listen, I didn't have the benefit of having this evergreen cost seg Q&A and podcast episode back in the day. So I just didn't know what I didn't know, so.
Yeah, totally.
Yeah. Where were you? Like 12 years ago or whatever it was. You were probably still in high school then.
Yeah, I was about
elementary
to say
school.
Exactly.
Yeah. Well, I'm old. Okay. So,
I think I was in college. I was in college or exchange student then. So yeah.
Okay. Yeah. I was old then and I'm older now even.
Wiser now.
Yeah. Wiser. I don't know. Depends on who you ask. Not if you ask my mom. Dang, I was going to ask you a question. I got too excited about that. I was going to ask you, just out of curiosity. So, I work with a lot of clients who, they're coming into this laundromat space. They're buying, a building with a laundromat, but they also have other investments. They have, apartment buildings. They have other commercial buildings, stuff like that. Just so, kind of everybody's clear on this, for a cost seg study, obviously that's going to depreciate. You're going to be able to apply the depreciation towards the income of that specific asset class, that specific property. So any income that it's bringing in. And then I think you said, like if you have the laundromat, you can also depreciate the part that you're using for the laundromat as well towards the income of the laundromat.
Yeah, so I'll try to touch on this. And just saw a question come in, David. So I just
Yeah,
acknowledging that. I'll touch on that here shortly. So
good question too.
the the if you had the strip mall example again, and we're running a mat out of one side, that's your business, and then you're renting out the other 4 units. Then the 4 units are considered passive income, but the part that you're using actively would be used in what's called the grouping election on your taxes to offset your active income. What that grouping
Mhm.
election essentially is saying is like, hey, I'm running my business out of this property, and this property is like materially required for me to run this business. It's like I'm actively involved in the management of this property because I'm running my business out of it. And by marking that grouping election, you can then claim that deduction for that portion of the property against your active income. So you'd have like two pillars there. And something else to kind of notice sometimes, if you don't have enough passive income, like you're not pulling that much rent from those other 4 units,
Mhm.
but you get 200 or $300,000 in depreciation that would apply to that passive income category. Well, that just carries forward into future years. For as long as it's there, it just kind of has like a bucket that just slowly gets chipped away. So if you're not making as much passive income as you have, passive deductions or money in that bucket, then you're not really going to pay any taxes on your passive income that you have because you did the cost segregation, which is kind of
Yeah.
cool too.
Cool. Before we get to Dave's question, real quick, just kind of like a piggyback on that. If I have multiple assets, let's say I buy a new apartment building or retail or whatever building every year, and some of that I'm getting a bonus depreciate. I, does it sort of like, can you like I don't know, cross contaminate it? Like, does it have to only apply to the one asset? The depreciation have to apply only to the one. Like, if I own a building for 30 years, it's already paid off. There's no more depreciation. Can I apply appreciation from a different building towards this one, or how does that work?
Not quite. So uh, depreciation is only like if you didn't do a cost segregation, right? And it was a laundromat building that you purchased, you have it for 39 years. If you are in that building, I wish you the best if this is the case for like 50 years, then you don't have depreciation for those last 11 years, right? Like you've
Mm-hmm.
already used up that schedule, it's gone. So when and it doesn't, you can't have like another asset that comes in and applies depreciation to another building. Like an asset just has its own depreciation schedule, and it doesn't like move or cross contaminate, to use your words. So like it's a virus.
Yeah, that's right.
The what you can do though is you can, if you cost segregate those additional buildings each year, then if you're not using all of it, it would again carry forward just like on your passive taxes. So if you um, somehow, I don't know how this situation would occur, but I guess it's not completely out of the ordinary, or like completely impossible, I should say. If you make like $10,000 a year, but you buy like $1 million building and you're actively involved in the management of it, and you cost segregate that building, and you get $300,000 of accelerated depreciation that you can apply, and it's actively applying to your taxes, and you make $10,000 a year, well, you're probably not going to pay any taxes for the next, what is
30
that, like
years.
30 years? Yeah, if
Yeah.
you don't make any more money.
Yeah.
And it would just continue to carry forward.
Yeah. Okay.
Yeah.
Yeah. And I mean, I think in that scenario, that's where the 1031 exchange can come in too, where, if you've already used up all your depreciation and that's a big deal to you, you can sell that building that you've owned for 50 years that has no more depreciation, 1031 exchange it, tax deferred, I guess, to a
Mhm.
new property where the depreciation can restart, the schedule can restart over again, right? Is
Yep,
that
yep,
okay?
exactly. Which, to David's question, I'll read the question here in a
Yeah.
sec, but 1031 would delay recapture. So for David's question, what does recapture look like on this depreciation when you're thinking about an exit? Phenomenal question.
Great
Uh,
question.
it can get a little technical, but like if you're ever thinking about a 1031, it's going to delay your recapture and your capital gains. Recapture is something, whether you do a cost segregation or not, that you will have on a property. If you don't cost segregate a property and you're just taking straight line depreciation, you would have smaller recapture if you don't 1031 than you would if you accelerate a lot of that depreciation, you're pulling more of that forward. You're going to have more depreciation that's recaptured as taxable income by the IRS. So recapture is first triggered when you sell a property. That's the taxable event has to happen first. If you sell a property for more than what you bought it for, recapture is triggered. So similar to cap gains, right? If you sold a property at a loss, you're not going to have cap gains. You're not going to have recapture on that. If you sell it for more than you bought it for, you'll have those. Recapture in itself, if you're not going to do a 1031, can kind of be an interesting strategy play, because if you are in a higher tax bracket now, when you do the cost segregation and we offset a higher percentage of your taxes, I'll just using extreme examples, we'll say you're at the 37% tax bracket, you're making $1 million a year. If you do a cost segregation and we get you $250,000 of accelerated depreciation, well, 250,000 at 37%, I just reduced your taxes. Let's see, 250. I just reduced it like $92,000, $100,000 off your tax bill, which is great. Now let's say you sell it the next year, but you're no longer in the $1 million tax bracket, right? You're now at the $10,000 level, and you've got this carry forward, I guess. If you're at that $10,000 tax bracket now, it's I think 11%, if I have memorized my current tax brackets correctly. Then when recapture hits, it's going to impact that at 11%. It's not going to be taxed more than 25%. So even if you were back in that 37% tax bracket, there are certain categories that when recapture occurs is capped at 25% and wouldn't exceed, back up to the 37%. So it's a nice little arbitrage that you can have in the IRS code as well.
Yeah, awesome. I'm just watching all the troll comments come in right now.
Yeah, that was wild.
We're not talking, just to be clear, we're not talking about segregation. We're talking about cost segregation, which is a tax strategy.
It's very different.
Yeah.
Very, very different.
I'm not sure. I think somebody posted something somewhere and people coming in. So, sorry if you're offended by tax strategies, but there you go.
Yeah. My definition is to separate. And all we're doing is separating categories of depreciation in a building through cost segregation.
Yeah. So, I think that's huge. And the recapture is, that's a real question, right? Because, and I should point out that no matter what, when you buy an investment property, or a business that has depreciation, you have to take the depreciation. It's not like an option that you can say, I don't want to pay recapture later, so I'm not going to take, like, you have to take it, or if you don't take it, you just lose it. And they go, go ahead.
Yeah. So recapture will happen whether you took the depreciation on the property or not. Like if you don't take the depreciation on the property, you did your taxes wrong. So if you sell the property for more than what you bought it for, there will be recapture on that for sure.
Yeah.
Did I answer that correctly?
Yeah.
Okay.
Yeah. You're just getting it. So, but all that to say, the recapture is a big question for sure that people have all the time, because, on the sale, I've talked with people who have sold properties and didn't understand that there was a recapture, and so they weren't pocketing as much money as they thought they were pocketing. So that's where it really, we talked about working with good people before, right? And having a good CPA and all that stuff. That's where this really is, comes in handy to have the right strategies in place for the depreciation recapture strategy for you in order to, again, kind of maximize the amount of money that you're making out of the assets that you have here. Yeah. Dude, I don't even know what's going on here
with
with
conversation. Like segregation, just look up the definition. It's to separate things. It's not like cost segregation is written out in Internal Revenue Code. This is, I understand.
No, they're just trolling over there. It's all good. It's just funny. Yeah. Okay. So, listen, one more time. If, well, maybe we don't want to do that right now. Actually, I was going to say, where can people get a hold of you? But maybe we won't do that. Yeah. Don't worry about it, man. There's just trolls going off in there right now. It's no big deal. Okay. So, it's an IRS term, Sarah. It's an IRS term. So talk to the IRS about it being offensive. Okay, so going back to the cost segregation stuff, where is the best place for people to go to just get like a baseline of, I mean, obviously like right here with you, and maybe it's just reaching out to you, but where's the best place to go for people to kind of get like a baseline of, you know, for their own particular situation of knowledge on cost segregation? Or do you guys have resources on your site?
Yeah, we do. We absolutely have resources on our site. You can check us out at mavencostseg.com. And you know what? You can email me, chris.p@mavencostseg.com. It's for tax advising. So if there's, you know, non-tax advice questions that are coming there, I probably can't help you out with that. I'm sorry. But yeah, cost segregation, it's a very real thing. Like you can just you change how your tax bill is affected by recategorizing things in the properties that you buy.
Yeah. Awesome, man. Well, listen, this has been incredible. Seriously, you know, this is one of the most profitable things that you can do if you own a property and a business, especially. This is, you know, we talk about ROI a lot when we talk about investment. Well, this is one of your biggest ROI things that you can do. And so definitely worth at least an email and maybe one of those free conversations over there to see if these guys can help you out with your situation. Anything you feel like we missed?
No, I don't think so. I didn't see any legitimate questions pop into the chat besides a couple there. So yeah, no worries.
Yeah. Good. I mean, do you want to answer this one? Who do you think would win in a boxing match between Sleepy Joe and Kamala? I'm just kidding. I'm just kidding. But you did get some compliments on your dental hygiene.
I know.
So
I'm glad.
all kinds of like, they're coming out of left field, good, bad, all of it, man. It's great. Well, listen, man, this has been a really good conversation, a lot of fun, and super informative. So I appreciate you taking the time to come on. And again, if you're watching this down the line and you think, hey, cost seg might be something that you could benefit from, you know, shoot them an email, chris.p@mavencostseg.com. Is that right?
Yep, that's correct.
Awesome, man. All right. Well, I appreciate it. And let's do this again sometime soon.
Yeah, look forward to it.
We'll invite everybody who's over there in the chat as well. Come on out. That'd be great.
Right on, dude.